Division 296 tax, the new 3 million and 10 million super tax, has now officially passed both houses of parliament. It becomes law and takes effect from 1st of July 2026. Most people think this only matters for the rich. That's a mistake. Even if you have nowhere near $3 million in your super today, this rule can absolutely affect your retirement, your partner, and your estate planning. So in this video, I'll give you 3 reasons why you should care about Division 296, even if your super balance feels small right now. I have done a full video breaking down Division 296, but at a high level, Division 296 adds an extra 15% and 25% tax on earnings from the parts of your super balance above $3 million and $10 million, on top of the normal 15% tax on super earnings. These thresholds will be indexed to the CPI in $150,000 and $500,000 increments respectively. So why should you care about Division 296 tax if you don't have $3 million in your super today? The first reason is simple. Just because you don't have $3 million in super today doesn't mean you won't get there later in life. Yes, as mentioned, the $3 million and $10 million thresholds will be adjusted for inflation, but investment return of super often exceed inflation. I mean, that's the whole point of investing for the long term, right? So even if you stop contributing completely, a balance that sits just under the threshold today could still drift over it in future, purely from investment growth. If you keep adding employer contributions and personal contributions on top, that crossover point can come even sooner. That's why it's smarter to understand how Division 296 works now while you still have planning options, rather than scrambling to react once your balance is already over the line. The second reason is more emotional. Couples often inherit each other's super. That means even if each partner's total super balance is nowhere near $3 million on their own, if one of them dies, the surviving spouse could still go over the threshold if their combined super is above $3 million. Let's say Frank and Jenny each have $2 million in super. They both have account-based pensions with a reversionary beneficiary nominated to each other. That means if one of them dies first, their super stays in the super system and continues as the other spouse's death benefit pension. Now let's say Frank dies on 29th of June 2028. On that date, Frank's $2 million balance transfers to Jenny. So by 30th of June 2028, Jenny now has $4 million in super. Notably, Jenny's super on 1st of July 2027 was much lower, but for Division 296 purpose, the relevant amount is higher of the opening and closing total super balances for the financial year. In her case, it is $4 million. Let's say the realized earnings of Jenny's super for FY28 are $100,000. Her Division 296 tax would be $3,750. I have built a Division 296 tax calculator. All you need to enter is the relevant total super balance and the realized earnings for the financial year. In my other video on Division 296, I walk through how to use a calculator and explain the maths behind it. So check that one out if you want the full breakdown. This example shows that even though Jenny only crossed the threshold at the very end of the year, she could still end up with a Division 296 bill for that year. If Frank had died just a few days later in the next financial year, Jenny may have avoided Division 296 for FY28 altogether, and she would have had more time to manage her year-end balance for FY29, potentially reducing or eliminating Division 296 tax. Before we get to the next reason, if you're getting value from this video so far, please take a moment to like and subscribe. It really helps the channel grow more than you might think. I really appreciate the support. Thanks heaps. The third reason is for anyone with a self-managed super fund. Even if your super is nowhere near $3 million today, you have got a use it or lose it opportunity with a deadline to reduce your future Division 296 tax. As mentioned, one of the 2 key numbers going into the calculation of Division 296 tax is the realized earnings of your super for the financial year. It includes things like interest, rent, dividends including the attached franking credits, and net capital gains on assets that have actually been sold. Division 296 starts from 1st of July 2026. Now imagine a self-managed super fund asset was bought years ago for $1 million. It was worth $2 million on 30th of June 2026 and is eventually sold for $2.5 million in FY28. From a capital gains tax perspective, the gain is $2.5 million minus $1 million, which is $1.5 million. However, using the same number for Division 296 doesn't feel fair because it would effectively capture growth that happened before the new law even began. To address this, self-managed super funds are given a one-off opportunity to opt in and reset the cost base of assets held on 30th of June 2026 to their market value for Division 296 purposes only. This means that for funds that opt in, they need to keep two sets of records because ordinary capital gains tax keeps the original cost base, while Division 296 uses the reset value. This election is optional, irrevocable once made, must be lodged by the due date of the fund's 2026 and 27 tax return, must apply to all CGT assets held directly by the fund. In other words, it's not member by member or asset by asset. The election is made by the self-managed super fund trustee. So if one member would benefit but another wouldn't, the fund still has to make one joint decision. It is also all or nothing for all assets, so you cannot exclude assets that are in a capital loss position. Because the deadline matters, once it passes, the self-managed super fund loses a chance to reset the cost base. So every self-managed super fund should assess the fund as a whole and decide whether the reset is worth making, even if no member is over $3 million today. To make that call, you will need solid 30th of June 2026 market valuations and some modeling. And trustee might also want to consider whether selling assets in a loss position before 30th of June 2026 makes sense. Now you understand why Division 296 tax matters, even if you don't have $3 million in super today. If you want a full, simple breakdown of how Division 296 works, watch this video next for a more detailed explanation. Thanks for watching. I'll see you in another one.